Hi, I'm Josh Misk, Vice President of Investments at Invisor. This is our May 2016 market update. Well, right now we're in a period where the demand for money has never been higher. In the US, individual savings has nearly doubled since 2008 to $8.4 trillion on deposit in US banks right now. And those new deposits haven't found their way back to businesses in the form of lending, as tighter regulations and a similar risk-off appetite by banks has kept that money tight. And what this has the effect of doing is pushing down yields on treasuries and bonds to the historic lows that we're seeing today, as people are willing to pay top dollar for that security. But looking at May, despite this risk-off sentiment, it was a relatively uneventful month, and markets, equity markets globally were generally up about 1 or 2%. Why? Well, there's a lot of positive data driving the world's largest economies today as well. In the US, employment and housing and consumption data being among that. But I think that this difference between the risk-off appetite versus this positive data that we're seeing more and more of, what that does is that paves the way for more volatility going forward. And in June, we see a particularly large number of catalysts that could have the potential to drive volatility higher as well. That being in Europe, policy in the US, and in the price of oil. Now in Europe, since the European Central Bank expanded their asset purchasing program in March, the picture in Europe has become a lot brighter. There's stronger household consumption, private credit is expanding, and borrowing costs have come down significantly. But there's also the looming threat of the Brexit vote on June 23rd. Now analysts are saying that it's about 80% likely that the British will vote to stay in the EU, at which point we should see positive wage and competitiveness reforms in Europe. But the lead up to that vote should keep investors on shaky ground. Now we also have the approaching November federal elections in the US, and with that being as polarized as it is, I think that also leaves investors on shaky ground, as there's a lot of uncertainty as to what these two very different policies will mean to the economy. But I think the more immediate threat to short-term volatility is the approaching, the highly anticipated approaching Federal Reserve meeting on June 14th, whereby the Fed may potentially increase the overnight rate. Now they would increase the rate because the economy has been doing well as of late and inflation is rising, and they would also give themselves more ammunition down the road to combat weakness going forward. But this tightening policy, this increasing rate policy, is divergent from policies that we're seeing globally where they're easing and trying to stimulate their economies. The Fed's trying to cap that inflation rate. So that divergence causes a lot of volatility. I mean, it's a positive thing in general, but there are growing pains. Now what these interest rate expectations of future rate hikes tend to do as well is they tend to drive the US dollar up. And what that does is that can potentially cause commodities that are priced in the US dollar to drop. And we may see that play itself out in oil. In the back of a long-awaited drop in oil production, prices have gradually increased. With those higher prices, along with restored production in places like Fort McMurray, there are more rigs back online. That's going to cause higher inventory levels, which puts pressure on prices in the opposite direction. If you add in a potentially increasing US dollar, it's a recipe for more volatility. So we do see a lot of catalysts in the coming month that could create more volatility and could create potential swings in currencies or in interest rates or in markets in general. But long term, we see a lot of positive data, and we do expect growth, albeit slowly. I think if you look at a month like May, where returns were positive despite all of this risk-off mentality, it really speaks to that point. So, I may sound like a broken record, but the message is the same. For long-term investors, stick to your goals. Stick to your plan. It's time in the market, not timing the market. You certainly don't want to be sitting on the sidelines if that risk-off mentality changes and you have part of an $8.4 trillion looking for a place to go. But expect volatility, especially in the short term. If you're looking for ways to take advantage of that volatility, pre-authorized contributions to your account always help, and look to invest in low volatility strategies. So that's our update for May. Thanks for watching as always, and we'll see you next month.